Hello everyone, this is Professor Raghavendra Adhyapak, KLS Kokti College of Commerce, Belgaum. So in today's class, we're going to start with the fourth unit, that is portfolio analysis and financial derivatives. Okay, so first we'll see what is the meaning of portfolio. Okay, so portfolio is a group of financial assets such as shares, stocks, bonds, debt instruments, mutual funds, cash equivalents, etc. A portfolio is a planned to stabilize the risk of non-performance of various pools of investments. Okay, so in simple words, what is portfolio? It is nothing but a group of different financial instruments where we can invest and we can reduce the risk. Okay, that is known as portfolio. So whatever different options we have to invest, that is group of financial assets, that is known as portfolio. Okay, so portfolio management guides the investor in a method of selecting the best available securities that will provide the expected rate of return for any given degree of risk and also mitigate the or reduce the risk. Okay, so what portfolio management guides? Portfolio management guides the investors to select the best available securities. Correct. So there are many securities are available. In that, which one is best and in which we have to invest to get the good return. Regarding that, it will guide the investor. Okay. So and also it will help to what reduce the risk and to earn the good profit. Okay, so return and risk दोनों क्या करना है मैच करना है. Okay, so we already studied that if there is high risk, return will be high. Okay, if there is low risk, return will also low only. Correct. So like that, the portfolio management guides the investor in selecting the securities where they can earn a good return or expected return by minimizing or reducing the risk. Okay, next is we can understand this concept with the help of one simple example. Okay, so what example say that Mr. Arun is there. Okay, so Mr. Arun is having a 1 lakh rupees and he wants to invest his money in the financial market. Here, the rational objectives of the Mr. Arun, that is the investor, is to earn the considerable rate of return with a less possible risk. Okay, so the ideal recommended portfolio for Mr. Arun can be as follows. Okay, so यहाँ पे क्या दिया है? There is one person called Mr. Arun. Okay, so he is having the 1 lakh rupees and he want to invest in the security market. Okay, so what is the objectives of that investor is to earn the good return with less risk. रिस्क क्या होना चाहिए कम होना चाहिए और रिटर्न क्या होना चाहिए रीजनेबल और इट मे बी नॉट हाई ऑल्सो लो ऑल्सो इट अ कंसिडरेबल और अ मॉडरेट रिटर्न होना चाहिए एंड मैक्सिमम क्या होना चाहिए पॉसिबिलिटी ऑफ रिस्क क्या होना चाहिए लेस होना चाहिए. ओके, सो लाइक दैट दिस सजेस्टिंग टू invest in the different portfolios of that rupees 1 lakh. Okay, so here is a one table. We can see that serial number we can given securities, investment percentage, security and returns. Okay, so there are four different options Mr. Arun has have to invest their 1 lakh rupees. Okay, first one he can invest in government bonds. Okay, so how much he can invest? 25% of his total amount means 1 lakh rupees into 25%. कितना हो गया 25,000. Okay, so this he can invest in the government bonds. Okay, so government bond में securities क्या होते हैं high होते हैं right. It is fully secured because the government is sure that he will return the amount. Correct. So when the security surety is high, then obviously return will be what low. Correct. Next is bank fixed deposit. So we can go for the FDs in the bank also. Correct. So 15,000 rupees he can invest in the bank where the security is also high. Correct. Highly securities because bank obviously after the matured period refund refund the amount of FD. Correct. So what will be the return? average return around 6 to 7%, or in some banks 8 to 9%, and an average return will be there. Correct. Next is equity share. So 35,000 in equity shares. So when we invest in equity shares, security is what? Low, means the risk is there. Risk is high. Correct. Why risk is high? If the company earns a good return, then only they are going to provide the dividend on equities. Correct. So otherwise there is no guarantee of a return. Correct. So it is highly secured, and return will be also high. Right. High return. Why? The risk is more, so return is high. Okay. Next is mutual funds, 25,000. So what is the security level? Average. It is not highly secured also, it is not highly risk also. It is a moderate or a average, and the return will be also the same on an average return we can earn. Okay. So with this portfolio, we can suggest to the Mr. Arun where the risk is less or a average risk, and the return is also low and a average, by which his objectives, that is less possible risk with a moderate or considerable return, can be achieved. Okay. So this is one example that how the this portfolio diversification or portfolios different investments in the financial securities can take place. Next is expected return and variance. So what is expected return? Expected return is the return on a risky asset expected in the future. Given all possible outcomes for a particular investment, the average rate of return is called as expected return. The actual return can differ from the expected return. Okay. The whatever the return we are expecting on a particular asset in the future time, that is known as expected return. For example, now we are investment in some company shares and we are expecting of dividend of 15 to 20%. Okay. That is possible returns, it is not actual return. We are expecting that possible हो सकता है, right? And we predicting on that particular basis, and it is possible outcomes of 15%, but we earn the actually 12%, right? Then we are earning less than the possible outcomes. Okay. So whatever the expectation we are doing on a particular asset on its future period of a time, that is known as expected return. And the actual return and expected return both are different. Okay. Actual return means actually how much we earned. Okay. And expected is how much we are expecting. Okay. For example, I told that 15% we are expecting from the some XYZ company as a dividend, but actually we received 12%, means actually received 12%, expected 15%. Okay. So this is what expected return concept. Next is variance. Variance measure the dispersion of points around the mean and distribution. In this context, we can attempt to characterize the variability of possible future security returns around the expected return. In other words, we are trying to quantify the risk and return. Variance measure the total risk of the possible return. Okay. So what variance is nothing but it is the measuring of total risk in a possible return. Okay. Just now I told that we are expecting the 15% return from this XYZ company, correct? So to earn that 15% of from the XYZ company, what are the different risk associated with that? Okay. So that will be calculated in the variance. Okay. Variance will measure that risk. Okay. Next is portfolio diversification. So what is portfolio diversification? Spreading an investment across a number of assets will eliminate some but not all the risks. Such spreading to reduce the risk in investment is known as portfolio diversification. Okay. What it is that portfolio diversification is nothing but spreading of the investment across the different assets. For example, I have a 1000 rupees. Instead of investing full 1000 rupees in single share, to divide it, some 100 rupees in fixed deposit of the banks, some 100 rupees in shares, some 100 rupees in derivatives market, another 100 rupees in another market or in FDs in bank. So like that different assets में क्या करना है, divide करना है. Okay, that is spreading, by which what will happen, the risk will reduce. Okay, such spreading of the investment amount across the different assets is known as portfolio diversification. Okay, so this is about today's class. In the next class we will start with the remaining part.